Hello, I'm Eugene Philalithis, Portfolio Manager of the Fidelity Global Multi-Asset Income Fund. Fund performance was positive over the second quarter, in part due to a broad risk-on environment in which equities contributed strongly to GMI's returns. While we continue to be positive on the outlook, the cyclical upswing in growth now looks to have peaked, and investors need to prepare for a return to more normal levels of volatility in the coming months. So even though our short equity futures were a slight headwind to fund performance, we continue to believe these are necessary in the event of a market sell-off. We size these positions carefully with the aim to insulate the portfolio in volatile conditions rather than to explicitly earn a return. In general, April saw the strongest performance across asset classes, with markets repricing European political risks. Markets are now more fully pricing strong Eurozone growth, but the region continues to be one of our favored equity areas, and we expect the positive macro story to continue for some time. There was also positive news for the European banking sector, as the authorities dealt with problems at Banco Popular in Spain and at two of Italy's major banks. European bank debt is one of our high conviction views, so it was good to see that problems in weaker parts of the market didn't affect the stronger areas. European bank debt and equity continues to be supported by attractive valuations and high yield levels. We have previously had specific exposure to US bank equity too, but we took profits on this back in January. As US banks have since underperformed, this proved to be the correct decision. Banks are one of the few asset classes that actually benefit from rising rates, as it allows them to earn a higher profit on their lending business. Now, markets are rarely this calm for long, so we're taking profits on positions which have done particularly well in the recent rally. This includes local currency emerging market debt, with investors once more reaching for yield and moving up the risk spectrum. But some of the factors that have supported sentiment towards emerging market assets may be fading. China's economy is slowing as the authorities tighten policy, while higher interest rates in the US would reduce the incremental yield investors earn in emerging markets. We're still positive on the asset class overall, but believe some profit-taking and adding back later is the right strategy. We're also continuing to build more defensive exposure into the fund, in particular our US dollar and cash exposure. US yields should drift higher as growth strengthens beyond the first quarter of the year and the Federal Reserve continue to tighten monetary policy. Once yields have risen, we can then begin adding back to areas like US Treasuries, further diversifying our defensive exposure.